Welcome, everyone, to today's session of the 2025 Financial and Tax Frequently Asked Questions led by Rick Fingerman. This program is hosted by the Blum Resource Center. Over at the Blum, we are grateful to Rick for this continued partnership. The recording of this session will be posted on our Blum YouTube playlist and our Blum Digital Resource Center. For those of you watching live, if you have any questions related to today's program, please feel free to utilize the chat feature throughout the session. At the end of the session, your questions in the chat will be used to moderate the Q&A. If you have any other questions or would like more information about resources and programs offered through the Blum, please visit our website at www.dana-farber.org/resource center or email us at blum_center@dfci.harvard.edu. Thank you all for joining us. I will now pass the workshop over to Rick.
Thanks, Sierra. So here we are in another of a series of how to manage finances during cancer treatment. Here we go. Well, the topic today is 2025 financial and tax frequently asked questions. These are questions that have come up in the last few months with patients that we help in the Dana-Farber Pro Bono Financial Coaching Program. That's a mouthful. And I'll talk a little bit about that. That is me in the middle there with that little trophy behind a check. Any money that we receive as awards goes to the Patient Assistance Fund. If you're not familiar with the Patient Assistance Fund at Dana-Farber, you should check it out because it provides a stipend to people that qualify. And that could be used for anything from parking to groceries to paying for your electric bill. So definitely check that out. It's called the Patient Assistance Fund. Little quick disclaimer. This information is strictly general in nature. It's not meant to be tax or legal, financial, medical, anything else. If you have specific questions, the last slide has my contact info, and I'm more than happy to speak to anybody that's part of Dana-Farber that has any questions specific to their situation. So feel free when we get there to jot my email address down. Just a little bit about the Dana-Farber Pro Bono Financial Coaching Program. So if you are a patient and you are struggling or a lot or just a little bit financially, maybe having difficulty paying bills, maybe you're wondering, where to access money, maybe there's some credit card debt, maybe you don't have an estate plan and you want to figure out if there's something you should do there with documents. The Pro Bono program is totally free. The estate planning, if you qualify and you live in Massachusetts, we don't have attorneys outside Mass at the moment, maybe Rhode Island, but we can actually put an estate plan together for you at no cost at all. You're matched with a certified financial planner practitioner that can help you with, again, all those different areas like debt, savings, how to pay bills, budgeting, all kinds of stuff. So feel free to check out that with your resource specialist or your social worker. If you don't have a contact there at all, again, you can reach out to me personally and we can see if we can get you some help. So the first question we had, this was a couple of these people asked this. I had to send a big check to the IRS this year. What could I do to eliminate that problem going forward? And this can happen for a number of reasons. So here's some things just to ask yourself if this happen to you this past year, or this year, past tax year. So did you earn more in 24 than in 23? If you did, and you didn't withhold enough taxes from your job or self-employment, then most likely you're going to have a bigger tax bill. We've had a couple people that had a change in tax filing status. They were filing jointly and they lost a spouse, and now they're not filing jointly, or they are filing individually for some reason. So that can make a big difference on your tax bill. We have patients that need money because they're not working and they need to pull money from somewhere just to kind of make ends meet. And sometimes a retirement plan like an IRA or a 401k at work is the only place they have available. Anytime you take money out of those types of retirement plans, that adds to your taxable income. And if you don't withhold enough tax, you're going to pay more tax because of that. Just as a caveat, if you are thinking of taking money out of a retirement plan, please get some advice from either a CPA, a certified financial planner, or if you're in the program, reach out to me, because there might be better ways to take money out than other ways that can minimize that tax impact. Something else on the other side is stop contributing to a retirement plan. So we've got patients that we sit down with, cash is tight, we're looking to increase cash flow. So we might recommend that they kind of hold off on on putting money into their plan at work. They might still be working, but this way we get more take-home pay that they can use to kind of pay bills and deal with those things. So when you don't put money in a retirement plan, your taxable income goes up and therefore your tax bill goes up. Somebody asked about a Roth IRA conversion. So just real quick, and I might talk about this a little bit later, I can't remember, but a Roth conversion is when you have an IRA, for an example, and you convert that to a Roth IRA. And when you do that, in the year of conversion, you have to pay tax on the amount that you convert. So if you didn't pay that tax and figure, well, I'll just wait till April 15th to pay it, well, you're going to get hit with a really big tax bill depending on how much you convert. So that's something to be really mindful of before you do a Roth conversion. You want to have cash available to pay that tax. Did you sell a home or other investments? So when you have investments and you sell them, generally that could hit this capital gain tax. And if you have a capital gains tax, and again, it's going to increase your taxable income. When you have a home and you sell that, if it's your primary residence and you live in there long enough, you can have either a $250,000 exclusion from taxes if you file single, or $500,000 exclusion if you file jointly. So that might help. If you don't know that, you're going to make sure you take that exclusion. But if you're selling a house and you don't qualify, or it's a rental property or a house that you didn't live in the last 5 years, then you're going to have a capital gains tax. And then lastly, did you pay quarterly estimated taxes in previous years? And those are people that generally are self-employed. They don't have a paid check per se to have taxes withheld. So they send in these quarterly payments to the IRS. And some people forget to pay them. Some people skip a payment here and there. So that's another thing to look at. Other than that, there could be some other nuances why your tax bill went up. If it went up tremendously, then that's something that's really you want to look at. But if your income stayed pretty much the same for 2024 than the previous year, and it went up dramatically, and none of these things apply, well, I don't know. We could talk about it and take a look. We'd have to really look at the tax return and see what's going on. The second question was, how does a Roth conversion work, and is it a good idea? Well, like most things financially, it depends. So a Roth conversion is money that, again, you convert from a traditional IRA to a Roth IRA. And the advantage of that is it provides tax-free income later on in retirement. With regular IRAs or 401ks, when you hit a certain age, you have these required minimum distributions that you have to start taking money out. And with a Roth IRA, that goes away. You don't have no more required distributions. You can leave that money in there forever, leave it to your kids or whomever you want. There's no taxes for you. There's no taxes for them. So it could be a great thing, but the downside is you've got to pay those taxes today, and you have to have the cash to do that. Again, Roth IRAs don't have required distributions, and tax is owed in that year of conversion. So you have to have that money set aside. I've been hearing a lot about annuity. Should I buy one? Well, this is another it depends question. So first, what is an annuity? There are different types of annuities. Simply speaking, there are fixed annuities and there's variable annuities. Think of a fixed annuity as like a CD. You have a CD, you give the bank $100,000. They tie it up for 3 months, 6 months, a year, 2 years, whatever it might be, and they pay you a set interest rate on that money. That's how a fixed annuity basically works, except you're giving the money to an insurance company, and the insurance company is saying to you, over that period of time, we're going to give you 4% interest. That sounds like a pretty good deal. The advantage of the annuity over like the CD is the annuity, you don't get a 1099 at tax time, so you don't pay any tax while that money's in the annuity, but when you cash that annuity out, you do pay tax. The other disadvantage of an annuity versus the CD, they both have kind of like an early penalty withdrawal, but the penalty can be much higher in the annuity than the CD. The CD, you basically lose some interest, and in the annuity, you actually can lose money that you put in unless you get past that, they call it a surrender period. And that can be anywhere from 5 to 7 years. So you want to be careful when you look at annuities. Variable annuity looks kind of more like a mutual fund in a way. It's an investment in either stocks or bonds or something like that. So it doesn't have guarantees like that 4% fixed annuity does, like a CD or a fixed annuity, but it has the potential to make money longer term because it's invested in stocks of companies and things like that. And lastly, there's a deferred annuity and there's an immediate annuity. So deferred is kind of like that CD idea. I'm putting money in there. I don't need it today. I'm just going to let it grow and I'll take it out down the road. The immediate annuity is you give the insurance company money today and you say, I need income right away. So they, based on your life expectancy, they'll send you a monthly check, for an example, of a certain amount for the rest of your life or for a period of time. So again, annuities can play a part in someone's financial life, but you want to be careful, and before you sign anything, definitely have it, speak to somebody that understands how these things work. On to number 4. I have several credit cards with high interest. Should I switch those to a zero interest card? We get this question a lot because a lot of patients are juggling a lot of things and they've got bills to pay and they might use a credit card. They're at Dana-Farber, they've got to get meals, they got to buy groceries, they might not be working. So credit cards seem to be the place to go when we have little cash flow coming in. And most credit cards can be 20, close to 30% interest. And at those rates, it's almost impossible to pay those things off. So they've come up with this idea, hey, you can switch these high interest cards onto this zero interest card, and you don't have to pay any interest for a period of time. I think I have a slide on how this actually works. If this is going to forward for me, it's been a little slow today. Here we go. So how they work. So zero interest for a fixed period. Usually it's like 12 to 18 months. I've seen some that are shorter, some that are longer. You still have to make that minimum payment, but the interest is 0%. So the concept is that if it's zero, I'm able to, in theory, pay it off faster because I'm not kind of trying to keep up with those high interest rates. You can transfer high balances from other cards, but you'll pay a fee. Usually it's around 4% of the amount transferred. So if you're transferring, $30,000 worth of stuff and they're charging you 4%, you're going to have a higher balance than the 30,000. But the idea is that you have a zero interest. So, but after that zero interest period is over, let's say you have a 12-month zero interest card and you have a balance, now the regular rate applies, and that regular rate could be, 18, 20% or more. So ideally, this strategy works well for people that say, hey, I've got 3 cards, I'm paying 20% interest on them. I'm going to switch them over to this zero interest card, and I know I'm going to pay these off before that zero interest period is gone, that 12 months or 18 months, whatever that may be. I've been doing this for 35 years, this business, and I've seen very few people that were able to pay these off before that thing ratcheted up again. Unless you're transferring a small amount, like a few thousand, and like, okay, well, I can pay that off. But when you're doing 10, 20, or 30,000 onto these cards, it can be really difficult to make sure these get paid off because, again, you're not paying interest, but you are paying that minimum payment. And if you're paying that minimum payment, that balance is still kind of big. So you're really going to be socking a lot of money towards these every month to get them to really work correctly. So again, be careful on these zero interest cards. I just finished treatment. Can I get life insurance? We've had this come up many times. People are in treatment, they're out of treatment. They realize they're low on life insurance. Maybe they've got some small kids at home and they wonder, can I get life insurance? Can I still get that? Because life insurance companies, they do underwriting, medical underwriting to make sure that that you're a good risk to them because ultimately they don't want to pay off. So anyway, but here's some ideas because if you just went right, if you came out of treatment today, went to, an insurance company tomorrow and said, I want to get a $500,000 insurance policy, they would most likely deny you. So if you're working, there might be a couple of things you can do. So generally, if you're working and they offer life insurance, there's a certain amount, it could be 1 time your salary that you can get with no medical underwriting. They don't ask any medical questions at all. So I definitely recommend getting that if you have no insurance. That's a good way to get something. And if you have a spouse that, might be the patient and you're working, there's opportunities usually to get a smaller policy. It might only be, 25,000 or 50,000 on your spouse with no medical writing again. So that might be a way to help if you're the working spouse and the spouse at home is the one that just came out of treatment. Now, based on the type of cancer you have and the length of time out of treatment, you could definitely be approved. I'm working on one right now. We have another couple of months to go, and the person meets this 3-year mark for the type of cancer that they had, and they will be eligible for a policy. So there are ways to do it. It's just not going to happen right overnight. and you might see ads on TV that show this guaranteed issue life insurance and no medical questions and this and that. Well, there's no underwriting, but there are medical questions. And if you answer yes to these questions, they might not deny you, but if something happens and you pass away in a certain period of time from that disease, then they're not going to pay the death benefit. So again, you got to be careful. If you have any questions on this kind of stuff, again, my slides, the last one, happy to talk to you about how that all works. Are there any ways to save taxes this year? Well, if you have low income, that could save taxes, but that's not really a good thing. So let's look at a couple of choices here. So one is something called tax loss harvesting. So tax loss harvesting is when you have investments and they lose money. So here's an example. You bought a stock, ABC company, in April of 22 for $10,000. Today it's worth $2,000. So you lost $8,000. As long as you've owned it more than a year, you can write that $3,000 off of ordinary income, or you can offset other gains. So the first $3,000 of losses gets deducted from your regular income from working. And if you still have more losses, that can get offset from other gains you might have. There's a little link here. So when you see the replay, you can click on that. There's another article that explains how that works in more detail. I don't want to make this a 3-hour webinar, so you can spend time there. But again, these are non-retirement accounts. If you have an IRA or 401k we talked about before, there is no tax loss harvesting because it's retirement money. Doesn't work that way. So anything that goes in pre-tax comes out fully taxable, except for, again, that Roth thing. If it goes in as a Roth contribution and it comes out, it's totally tax-free if it meets certain requirements again. So be mindful of tax loss harvesting could be a way to save some taxes if you have some investments. Flexible spending accounts, if you're working, you could contribute to these things called flexible spending accounts, or FSAs. And this is where you put pre-tax dollars in from your paycheck. If you know you're going to have some kind of medical expenses that year, this is generally you need to use it or lose it. So it's kind of like a year by year look at this when you put money in. So let's say you've got, teenage kid that need braces. It's going to cost, I don't know what they cost, but let's say $5,000. Maybe that's the deposit today. I don't know. But you could put, money into that flexible spending account and then take that out to pay the dentist. And it's not a bad deal because, again, the dollars are going in pre-tax, so you're saving some taxes. Generally, this is during an open enrollment period when you can enroll. But if there's some qualifying life event, if something's going on in your life, there's certain reasons here like family leave, death of a spouse, or other reasons, you might be able to get money into those things. So it lowers taxes that you would otherwise pay. Makes sense to do it if you want to learn more how it works. Again, there's a link here to get more detail. This is something we don't see too often on the Dana-Farber side, but in my practice, we see this quite a bit. So this is called a qualified charitable distribution. A mouthful. So what that is, or QCD, is if you're over 70 and a half, you can take money from your IRA and you can give it directly to a charity. And that lowers your taxable income. Generally, people do these when they're at that required minimum distribution age, which starts at basically 73 if you were born before 1960 and 75 if you were born after 1960. If you have an IRA, you've got to take money out of these accounts with this required minimum distribution like we mentioned before. And you could satisfy that if you give some or all of that required distribution up to around $100,000 to a charity. So you could basically give money to Dana-Farber, let's say, and you wouldn't have to pay any tax on that. It's a good way to give if you're charitably inclined and if you have an IRA and you're at that age bracket. Doesn't apply to too many people unless you meet all those guidelines. And then donor advised fund is another way to give money. So again, you could do a donor advised fund with non-IRA money, and you might name Dana-Farber for an example. The advantage of a donor advised fund is you put money into it, but it doesn't have to go directly to the charity right away. You could let it grow inside the donor advised, let's say the Dana-Farber advised fund. Maybe we could create one of those. A donor advised fund, let it grow, and then at some point in time, you could give that money to the charity. So this could also work if you had a church or synagogue that you generally make a donation to. you could put money in a given year that you might have high income, and then you could give that money out to that charity or that church or synagogue or whatever over time. So it's a way to kind of play the tax game and keep your tax liability down. And the last bullet point, maybe best to gift appreciated assets versus cash. It gets a little complicated, but let's say you have an investment you put in, like that other one where you bought that stock for 10,000 and lost money and it was worth 2,000. Well, if it was the other way around and you put 2,000 in and it was worth 10,000, you have an $8,000 gain. If you sold it, you have to pay tax on that $8,000. This is a way you could just give those shares of stock directly into the donor advised fund, don't pay any capital gains tax, and you get the tax deduction for making the gift as a charitable contribution. So a lot of stuff here. Again, there's a link here if you want to learn more about how all that works. And then financial planning, we here at my firm are a financial planning firm. So we look at all the different areas of someone's life, whether it's money coming in and money going out, and retirement and investments and insurance planning and tax planning and estate planning. But if you do some basic financial planning, look at your current expenses, you'll have fixed expenses, you'll have variable expenses. The fixed are things like, your rent or your mortgage or your car payment. The variable ones are things like, could be heating oil, could be electric bill, could be going out to dinner or buying groceries. So you can't do a whole lot about the fixed expenses, but you can generally do a lot with the variable ones. One key component that we try to get the patients to work toward is setting up an emergency fund. And that's money that's set aside in just a simple, boring account that maybe is making 3% interest today. That's just there for emergencies. If something happens where things get worse and you can't work as much, you stop working, you have bills to pay, there's money set aside to take care of that. And then as far as like workplace retirement plans, we talked about people stopping putting money in because the cash flow is tight if they're in treatment and they're struggling financially. But if you can, you want to put in at least as much to get that company match, if there's a company match on that 401k or 403b plan at work. And then lastly, you want to complete that estate plan because if something does happen to us, we just never know. We want to make sure there's a plan in place that takes care of that so your family's taken care of and nobody has to scramble and really worry about things. And again, if you're part of the Dana-Farber family, we might be able to get you a estate plan at no cost to you. So if that's something that interests you, reach out to me. We can talk about that. And there's a video that kind of puts it all together. We'll look at that later on. And this is my last slide, my offer to you again. Any questions, feel free to reach out to me. It's always best to email me at rick@planwithfps.com because I generally don't answer the phone much during the day because I'm in meetings. But if you email me, I can send you a link to my calendar. We can set up a call and we can walk through things. I think that is it.
Thanks so much, Rick, for that helpful presentation.
Sure.
That had a lot of great information, so thank you for sharing that with us. If anyone in our audience has any questions, please feel free to drop them into the chat or the Q&A. I haven't seen any come through yet, but now is the time to do so if you're interested in asking Rick any questions. As I mentioned earlier, the session was recorded and it will be posted on our Blum YouTube playlist and our Blum Digital Resource Center. Thank you again, Rick, and I'll just leave another minute for anyone to put any questions in if they're wanting to ask. Right. Doesn't
Maybe another question came in. No?
That one was just saying thank you.
Oh, thank you. Okay.
Awesome.
You're very welcome.
Well, everyone has your email and phone number if they have any questions.
Yep.
But I want to thank you again, Rick, for taking the time and for putting together another fabulous presentation.
Absolutely.
Amazing. Have a great week. Thank you, everyone.
You too. Thanks.
Bye now.
Bye.